I am not in real estate. I am running a technology company that is masquerading as a real estate company. And it has always successfully masqueraded as a real estate company, and I think it always will be. So all I did was I moved from core technology to real estate technology. So that jump is smaller than most people think. When you look at the org chart of my company, I have 24 employees. It doesn't resemble the org chart of a real estate company. Obviously, there's people like underwriters and asset managers, and that looks like traditional real estate for somebody that's running a $300 million portfolio. But the massive majority of my company is actually running like a .com, and like every .com, we have a very outsized, massive focus on eyeballs, on content development, on having 12 or 13 different incoming pipelines, both for cold leads and for warm leads. And then we have entire departments processing cold leads and turning them into warm, and processing warm leads and turning them into investors. So the one that has been the biggest has also been the one that's slowest. So there's a, so I'm going to tell you that story, and I'm going to explain how it happened. And yes, this is the one with the most checks. So when I was in technology, 2003, I was building campuses for my company. So I was basically in real estate, but I was a technologist running a real estate technology company, building these large custom campuses for our personal need, well, for our company's needs, right, using the company's money. So there were no investors. We were the investor ourselves. So when we're building these campuses, I got interested in real estate, learned about the depreciation benefits, and they were great for me because I had the big fat tech salary, 50% taxes. I live in California, so 50% of my salary was taxed. I saw the depreciation benefits. I'm like, ooh, this is great. I got to do more real estate. Right. So I started doing real estate, after building those 6 campuses and getting those depreciation benefits. And I'm doing predominantly single family real estate. And I'm basically, like any other good data scientist tech, I'm mining websites, I'm spidering the Department of Labor website, and I'm making copies of the Zillow website and taking all of that data and mashing it and trying to see patterns in the data. Like any good data scientist, we're trying to read the tea leaves, because one of the things that data scientists do differently is they come up with a hypothesis and then they use data to test it, right? So they don't just go out and willy-nilly invest somewhere just because it's 10 minutes away from their house or because somebody said it. They want to create a hypothesis and then test it. So I went through this process of testing a lot of hypotheses, and then I started publishing my results on the web, and people really liked what I was doing because I'm in Silicon Valley. Everyone around me is a geek or a dork, right? Take your pick, right? So we only come in 2 varieties here, geeks and dorks, right? So, or there's a third variety. People tell me uber dork, right? So amongst in this land of all these geeky people, I was like micro famous all of a sudden because I was basically taking hundreds of real estate metrics and I was applying them to hundreds of different cities and publishing my results. And so initially it started with people calling me to local meetups to present my ideas. And I've always been an entertaining presenter because I realized that, numbers are boring. So you really have to break it down to something that people can understand, right? 25 years ago, somebody had said to me, when you're teaching people, you're first an entertainer, then an educator, right? And if you get the entertainment part wrong, you could be the best educator in the world. Nobody's ever going to get anything right out of it. So I learned that lesson well. So when I'm teaching, I'm entertaining people. So people found it fun, and so local meetups started calling me in, and then podcasts started calling me, to do podcasts. I think this is my 120th podcast that I've done. So when I did that, when I was doing these pieces, what I realized was that no one was really publishing this content. If they had something good, they immediately went to a venture capitalist and they tried to get $100 million for it. So I said, I'm going to take the other approach, which is the Google approach. Google was giving Gmail away for free. Google was giving Maps away for free. I'm like, I really like this approach. I have no idea how to monetize this, but I'm just going to, I don't have to make any money because I'm a tech guy. I have a big fat salary. I'm just going to start giving stuff away. So I started building toolkits and then started building courses. So I built the toolkit. I called it Real Focus, and it's a data-driven but very simple methodology on how to figure out the best cities and neighborhoods in the U.S. to invest in. And then I said, the toolkit's good, but I should actually turn it into a course, and I should give the course away for free. So I put the course on my website, and there were 100 people taking it every year. And I'm like, no, this doesn't work well. So what I did was I gave the course away for free without having access to people's email addresses on udemy.com. So udemy.com. real focus. And I was like, if instead of 100 people, I get 200 people a year, I'll be happy. Well, it just exploded. So right now, if you go to udemy.com/real focus, there's 7,000 people taking the course today. And there's 500 five-star reviews. It became the most popular real estate course on the entire website. They've had hundreds of real estate courses, but it became the highest ranked and the most popular simply because what people liked the most, Dr. Gower, was that there was no agenda, right? I had nothing to sell. I was not a real estate guy. And so I was basically just saying, I am a Silicon Valley dork, and here's my findings, and use them if it's appropriate. And so what the course does is it is a set of 5 rules for identifying the best cities in America to invest in, and 5 rules for identifying the best neighborhoods in those best cities. So 100% data driven, no gut feel, no experience. You're simply looking at data to make better decisions. And it's not perfect. It's really not a set of rules. It's a set of guidelines, right? Your gut feel still works. And so people started really to like it, and they started building upon it. They started developing it. They came back to me and gave me improvements, which I subsequently made to the course. And what happened was Udemy doesn't share those people's email addresses with me. So for it to become a successful funnel, when I did finally sell my technology business and move into real estate, become a syndicator, I now needed to raise money for my syndications, $3, $4, $5 million at a time. It was the same thing that you were doing, Dr. Gower. I hired content writers. And those content writers would write 3 emails a month about my content, and a 4th email a month that was basically a sales page for my projects. What I started doing is I hired a content person and I put them together with a virtual assistant. That content person would write 4 of these emails every month, and sometimes they were repeat. So it's not like they're writing them every month. They're repeating them every 3 to 6 months because people are coming and going. And then I've got the virtual assistant that posts them. And by doing so, I was able to drive a massive amount of traffic to me that was already branded traffic. The people that took this course love me, right? I mean, because we pretty much get all 5-star reviews. So it's about averaging 4.8 out of 5. And so people love the fact that there's nothing to buy in the course. The course established my brand name as somebody that's data-driven for investing. And I said, I didn't say that. I didn't say don't bother. I said, I believe everyone that took my course should be using it to buy their own properties. And if you were to come and ask me and say, should I only invest with Neal Bawa? My answer is no, that's a bad idea. My answer is that you should try both and figure out if you're the kind of person that can truly optimize properties by yourself, or are you the kind of person that wants to take a back seat? Are you the kind that just wants to buy Apple stock and sit with it for 10 years? You're not going to find that out unless you do both. And here's a course that allows you to go out and buy yourself. But note that I'm using the same course and the same methodologies to buy multifamilies, which have economies of scale that you do not have and never will have with single family. So you should look at my deals as well. So it was a very soft pitch. And even in that pitch, we were saying, but don't forget to buy your own single families. So we do both cold and warm leads, and we keep them in 2 separate databases. So we have what is known as our main database, and it has about 22,000 active people. And then we have what is known as a shadow database. The shadow database is basically cold leads or people that don't know us, and we dump massive numbers of people in there, and then we also remove them. One of the key things that we do that most people don't do is if they're not interested, we get them out of our database, because what we find is deliverability levels for our emails go down if we let them be in there. So we're extremely Nazi. There are periods of time where our database is shrinking even though we're adding large numbers of people. That's because we have a very aggressive removal policy. If they're not interested, the last thing we want is for them to clutter our database, because we're using high quality providers like ActiveCampaign or MailChimp, and keeping people in our database costs money. A lot of people are like, well, I'm going to buy a list of 10,000 accredited investors from the web. And firstly, most of those are bad email addresses, right? So, once we've sent them through a cleaning mechanism and maybe we bought 10,000, now we're left with 5 that are actual good emails. Sending emails to them at that point in time, trying to sell them a $100,000 syndication is a waste of time. You shouldn't even bother. So what we did is that we first started inviting them to extremely content-rich town hall events that we do. So right now we've done 6 town halls that are the impact of COVID on X being single family real estate, student housing, senior housing, industrial, multifamily, and so on and so forth. And what we did do is we bring in guests who are told that this entire webinar, like 75 minutes of content, is zero pitch. You're not going to say what you do. We're not going to say what we do. It's simply high quality content. And lots of times people are like, no, I need to pitch something. Well, the answer is sorry, right? You can't. So what we do is we use our army of virtual assistants. We have 18 virtual assistants to find very high quality people that are like, just, yeah, brand building is enough. I know Neal has a huge database. It's not going to be 50 people on Zoom. It's going to be 2,000 people, right? So they know that. So they're like, fine, I don't need to pitch anything. I'm just going to come and talk about my experience. And so we bring in these high quality people, and we do this 75-minute event, and we basically push that out to the cold database. But there's a tweak in there that I think most people listening will find very compelling. If I send that email from neal@growcapitalist.com, the conversion and open rates are very low. So what we do is we send the email out from Eventbrite, or from LinkedIn, and from meetup.com. So those are three of our channels, as you can imagine, right? Eventbrite doesn't create a lot of registrations by itself. So, if you post an event on Eventbrite, you might get like 5 people, right? But what I do is I basically take my cold database and send them the email invitation through Eventbrite. And because of the brand of Eventbrite and the fact that nobody wants to unsubscribe Eventbrite, I get a much higher open rate and a much higher engagement rate. The other piece that we do is you're inviting somebody to your event. Let's say Dr. Gower has the best content-driven no-pitch events ever. Okay. The problem is this. What people don't do is they don't get reviews from people that watch their events. So what we do is when we have these content-driven events that 2,000 people have watched, we keep sending emails to them saying, could you consider writing us a review? So we solicit reviews, right? And then we take the best reviews, and in our next invite, 50% of the space in that email is filled with reviews, right? And 50% of it is about the content. And then we keep asking people to give us Zoom video reviews, and we put those Zoom video reviews in there. So now you've got almost 2/3 of an email that we're sending out filled with reviews from people that have been watching our events, and those are both written reviews and video reviews. That doesn't improve the open rate, but it massively increases click-through rate, right? So now we've got super cold people coming in through lists. I mean, LinkedIn is the equivalent of a list, right? And so is meetup.com, so is Eventbrite. But by inviting them over and over to these pitchless events, we turn them warm. When they turn warm, and we have obviously data and metrics around that, we transfer them to the other database, and now the drip campaigns start, and the invites to raises start. Again, the devil is all in the detail. I know that many syndicators have tried Facebook. It's extremely expensive, doesn't work well, conversions are low. My feedback to them is, it's because you are not creating lookalike audiences of your accredited investors, right? So let's say I have 500 accredited investors that love me, right? You have to, for a moment, stop being paranoid, and you have to upload those 500 investors to Facebook as a look-alike audience. Then what we do is we basically target extremely rich areas of the United States and only run Facebook ads on those areas. So what we're doing is we're targeting for income. We're targeting for lookalike audiences. We will frequently buy a list of 1,000 MDs who may have no interest in real estate, but we upload them to Facebook as a lookalike audience. Well, now Facebook starts serving our ads to MDs. All MDs are accredited. Therefore, our click-through ratio improves. Now, take that and multiply it 100x. I mean, it's the same strategies, but applied across a bunch of different platforms, across Instagram as well. We apply it across so many different platforms. I haven't been to a meetup group for 2 years. I think meetup groups are a great place to get started, right? But even when you go to a meetup group, in my mind, we will have a vaccine in about 4 to 5 months. I think that 6 months from now, people will start going to meetup groups again. So, it was a one year pause, but I still think it's a great source. But when I see people doing these activities, and I'll give you online examples and offline examples, I think that there is a real lack of intent people basically will go in and then they will expect money to happen. What we've discovered in our company is everything is done with intent. And I'll give you specific examples so you understand what the heck does this intent thing that Neal's talking about mean. But bottom line is this: you've got to make sure you understand the mindset is you can raise money online just as much as you can raise money in person. You've got to use tools. You've got to get in front of people. FaceTime matters. Look at me. I mean, I've got the background. I've got the logo. I've got all of that set up. I've got the camera with the lighting. This stuff matters a great deal, and I think people don't fully understand that, right? And also, you have to build a brand to do this online. I have a very simple brand. I mean, Mad Scientist of Multifamily. If you type that in, there's only one person you're going to find, and it's Neal Bawa. And my name itself, Neal Bawa, is a brand, right? So I have 100,000 people that know me. The process of building the brand was very deliberate. And people are like, no, I'm trying to build my brand. No. How many hours in a week do you sit down in a meeting by yourself or with other people to say, this is our brand building time? Do you have in your calendar a day which is a marketing day? You have on that day sections of your day which are like brand building activities. And are you trying a half dozen things? That's intent. That's you going out there and saying, I refuse to do anything else during this time except build a brand. And that has nothing to do with getting investors. Building a brand is a process of becoming an influencer. And then as you do that, then you start a separate process of bringing cold leads into that influence funnel. What I find is people don't spend enough time thinking about what is their brand? What do you care about? I care a great deal about numbers, right? I've only ever come up with one quote in my life, but that quote was, the Bible got it wrong by one letter. One letter. It is not the meek that shall inherit the earth. It's the geek. It's the geek that are taking over the world. And I have belief in that. So that's what I care about. And so I build my brand around that. I don't see enough people doing that with intent. So what I would ask you to do is, don't start with 50% of your time going towards brand building. Commit to, let's say, 10%. So if you're committing to 10% of your time going on brand building, right, then what that means is all you need to do is look at your existing deal finding, deal activities, and figure out which 10% is the lowest yield and get rid of that. Because if you don't, you're in the rat race and you'll forever be in the rat race. Here's a question that no one in the history of syndication, no one in the history of multifamily syndication has ever asked, and I'm always irked why they haven't. What is your exit? And when I ask this question, this is my favorite question to ask because it really trips up people. They're like, no, I don't have an exit. I mean, my company doesn't have any value. The value is all in my building. So if I fund a project, then I'm going to make money on that project when it sells 3 or 5 years from now. So, and I look at that and I said, don't you see that as a failure? It's like, no, I'm making money. The answer is no, it is a failure because your core company, the company that you built, the one that does these syndications, it really has no value. It has no value. The value is all in your investor database and in your properties. Well, then you can never exit because the moment you stop doing these projects, the value of your company falls to zero. And they're like, yeah, I have to continuously do these projects. And the answer is, that is an awful thing. It's absolutely awful because in other businesses that we run, we always have an exit in mind. We have an exit saying, I will build up my company's net profit to $20 million. I'll get a 10x multiple, so it's going to be worth $200 million. That's what my selling price is, right? I've never heard people in real estate do that. So from the very beginning, I knew that this place was structured wrong. So I have an exit in mind. And for that exit in mind, I needed to build a competency in my company so that if I could take this to a venture capital company and I could say that my company, it's called Grow Capitus, my company, Grow Capitus, will continue to make you huge amounts of money on your investment after I leave. And here's why. That's the company I wanted to build. And so my question every day is, how can this company continue to make huge amounts of money if I wasn't involved? And every day I ask myself that question, and every day that question comes back to, well, build a personal brand and then transition it into a company brand. Build a massive amount of competency and systems that have value to anyone that's a venture capital person, and then continue to pull yourself out of it to the point where you're doing nothing I'm building the largest non-institutional equity funnel in the industry, in the real estate industry. My goal is not to take any money ever from family offices, not to take any money from super high net worth investors, which allows me to have 100% control of every deal that I do. What I'm doing is building an engine to bring in ever large amounts of equity. And if I am able to display and show and demonstrate to a private equity firm that this funnel will expand regardless of whether I'm here or not, they know that my company will make more money every year with or without me. And then I get a multiple two different ways. Obviously, all the properties that I'm involved in, I have an exit for those properties, but I also have an exit for the base company, Grow Capitus. I'm well on my way. I think within 2 years, I will be able to walk into a venture capital firm in Palo Alto, explain to them what exactly I have done, and say, I intend staying on because I'm enjoying myself. But if I don't, you're going to buy the company not because of Neal Bawa. You're going to buy the company because of what I've built. And some of them will say, no, not quite. And the answer is, I'll be back in 6 months. And I'm going to show you how much progress I've made in the last 6 months, not me, but my company's progress. Never wanted to be somebody that writes equity checks. So what we do is we stay in the project. We have asset managers. We stay in the project. We manage the project. We have an army in the Philippines that generates 20,000 tenant leads, processes those tenant leads in real time, sends out 50,000 text messages, schedules appointments. We have another army that basically works with developers that are selling townhomes, and we do the sales for them. So it's not just us raising money for the townhomes. We sell the townhomes. So the developer is basically just building, right? The beginning and the end is us. We build the websites to sell those. We generate the lead flow. So we build systems so that we can have developers do what they're good at, which is developing and building, and we can have syndicators do what they're good at, which is finding and managing properties. And with us adding the top layer of massive amounts of tenants coming into the property, right? So we're bringing 10x or 100x the eyeballs that they're capable of doing by themselves because they don't have the infrastructure that they've built. When I go into a venture capital firm and say, I'm the only company in the United States that has this infrastructure built, and let me show you what I did in the last 12 months with this infrastructure and how it affected my properties, that's sellable. People lie when they say that 5 years from now they'll be having fun doing what they're doing. I think, and I know there's some different people. I was speaking to one of my peers. His name is Brian Burke. He runs Praxis Capital, well-known company, hundreds of millions of dollars. He says, Neal, I don't know how to do anything else, so this is the only thing I can do. And I said, Brian, you're blessed in one way, in that it's this simple for you. But for somebody with a mind as creative as me, doing the same thing 5 years from today is a failure. So we're two different kinds of people. There's no right and wrong here. So for me, 5 years from now, either Grow Capitus will do something totally unique, different, or next level, or I'll be off doing something else, where Grow Capitus will either be owned by venture capital, or the other exit, which I like equally, is I'm going to promote my managers to CEOs, and I'm going to become chairman, show up once a quarter. What you do is you spend an enormous amount of time and effort finding an investor, and then he gives you 50 or 100,000, and then he doesn't have money again. So the challenge is the minimum investment with syndication being 50 and 100 grand, people can't repeatedly invest. So your funnel is a very one-time funnel when you start out. Now, as you can imagine, I have already found ways around that. But when I started out, it was like, so this guy loves me, and I've spent all this time, and he gave me 50 grand, and he's done, and he's probably going to come back 2 years from now and he has more money. That truly sucks. I want a subscription. I want to give me $50,000 a month. How do I do that? I became very, very fanatic about focusing on the very high-end salaried individual or somebody that was, high net worth. Now, when you do that, you're essentially throwing away 50, 60, 70% of your lead flow. But by targeting high net worth individuals that are high net worth, and doctors and so on and so forth, we changed our pitch. We refined our pitch. So our targeting mechanisms and our hit rate became a lot better. And that allowed us to basically leave aside everybody else that's the $50,000 a year person. And I'm not saying we don't get money from those people, but we do absolutely nothing to try and get money from them, except send out blast emails, right? We do 506C projects. We don't touch 506B. And so the other piece that fixed it was we basically said we are not going to do 506B projects. We are going to do C's only, which means that from the very beginning we know that we're going after accredited investors, and that's our only domain. That's where we live. And I'm shocked that syndicators have been syndicating for 5 years and still doing 506B projects. In my mind, that is a cop out. It's cowardice. They need to move up to the real game, which is 506C. Investors get a good gut feel or a bad gut feel about you, and that never changes. And it permeates through your entire database. The words that you use matter a great deal. So take your time, go a little bit slow. Don't try to sell one deal. Try to sell your competency. And in fact, do the takeaway deal where you say, it doesn't look like you're ready for this one, but you'll be ready for the next one. There'll always be more coming. That takeaway process is one that people don't use enough, and it gets us lots and lots of sales. So we basically don't try and sell any particular deal. We sell our competency. So develop that competency, whether you have technology skills or not. Doing that is going to give you a long-term pipeline that's much better. I think online it is that deals look very, very good on paper, especially on digital paper on the internet. And so at some point I became so overconfident and cocky that I thought that data and systems would kind of make up for the fact that the boots on the ground was not there. And what I've discovered is you can never in the real estate business get away from the boots on ground. All that the data does, all that the targeting mechanisms do is make you more efficient, but they don't reduce the boots on the ground need by even 1%. Don't invest in markets based on their future growth. Invest based on where their growth has been in the last 24 months. Too many people are like, here's a ghetto area, but someone's building a golf course on the other side, or someone's building this massive building a mile away, so this area is going to improve. The answer is, please only invest your own money on those kinds of premises. I've invested other people's money that way and learned the hard way that some of those things can get delayed. You have the best of intentions, you're not trying to do anything wrong, but stuff gets delayed, stuff gets canceled, stuff gets pushed out for a variety of reasons, and now you're running a project that's suboptimal in some way. Maybe it's tenancy, or maybe it's demand, and it's not worth your time, and it's not worth your investors' patience. Key habit is an offline habit that makes me successful online, and it is following the miracle morning. Other people call it atomic habits, but it's essentially that hour of the morning that gets you set and started up. I highly recommend the Miracle Morning. I tell people it's the most important book in the world. It's not the best book in the world. It's probably not even close, but it's the most important book in the world, because if you follow it, you'll probably end up reading hundreds of other great books, including the best book in the world, whatever it may be for you.